How are we doing? Happy Wednesday. How's everybody? Apart from being squeezed by the yen and the Swiss. Morning, Peter. Morning, JC, Gav, Yoko, Evil, Virginia, Rodrigo, Momo, Mark, Michael, Christian, Amy, Steve, Chucks, Harold, Antonios. How are we doing? So we've just had the pound figures come out this morning, CPI. I think the best way to describe myself at the moment is fundamentally confused. So the inflation figure for the pound year on year was 3.4 on a forecast of 3.5, which means we want to bring interest rates down faster because it's dropping faster than we expected, which is negative for the currency. No movement. So I don't really get fundamentals at the moment. Nothing is doing what it should be doing. We've got an interest rate rise on the yen, making the yen weak. We've had the New Zealand dollar not changing its interest rates and inflation being high, meaning it might need to put them up again, dropping. And now we've got a positive CPI move for the pound, but it decides not to drop. Really don't get what's going on with this market at the moment. It's all over the place. So the figures came out at 3.4, which is not far off a forecast. We were expecting a drop, but that is faster than normal. So as I would expect, where's my pen? There it is. Bear with me 1 second. Pen's loading, probably the most high impact software application on my computer. A pen takes ages. So as you would expect, traders are now expecting rates to drop faster than expected for the pound, meaning negative pound. So that should be a drop in the pound basically today. But we'll wait and see what happens. Hunt, as inflation comes down, opens the door for Bank of England to bring down interest rates. So we go. So that's exactly what you would expect on a red news event like that, where we are getting inflation dropping quicker than usual. Market doesn't seem to be reacting at all at the moment to it. It may be because we're waiting for the FOMC this evening to see if they decide to change their forecast on interest rate drop. But I don't know. We'll wait and see. Good reason to have non-direction strategy at the moment. Yeah, tell me about it. This is weird what we're getting at the moment. The trouble at the moment with fundamentals is, as I've said quite a few times, we've never been in this situation before, where when we've had an 18-month interest rate hike so fast and so quick, and then stopped literally, and nothing happened. We're kind of hovering with our engines idling, ready to turn them off, but no one seems to know when this is going to happen. So every time you get an event in the market that looks like it should do something, we're getting complete inverse on them, but only for short periods of time, which obviously doesn't help. So, but yeah, so pounds today, you would expect, and which is kind of what it looked like it was going to do when the news came out. You would expect the pound to drop off of this news today, because it means that we will definitely be falling in line with the US. If not, I mean, unlikely it would be sooner. If you look at the interest rates at the moment for the pound, we're still sitting at 4%. Yeah, so it's still high. Well, 3.5 now, obviously. But we're still sitting very, very, very high. Looking at the US as a comparison, and Canada, we're behind the curve. So it still indicates that there should be a drop coming June, but the market doesn't seem to be reacting to this at all. It's absolutely bizarre. But anyway, coming down against the US, but that's probably the US rallying, I would admit. Yeah, US is rallying at the moment. So US is rallying into FOMC, doesn't help the yen. So let's have a look at RSIs and ADRs. The yen, again, looking at financial juice overnight, nothing from the Japanese at all. Slightly worrying. So normally when we get to these sorts of levels on the yen, we're sitting up at levels of this magnitude, as there and in previous, we've had intervention moves coming around this 150 level. So they intervene, you push back, they intervene, you push above, they threaten, you push above, they threaten, they intervene, and you do as they say. Yeah, this is basically the normal behavior when we start getting extended. We haven't had any of that. We did have a little mention of it after the rate change yesterday from Kashida, somewhere back here. But they haven't mentioned anything overnight at all, which is slightly worrying, because it could mean that they have decided that the new course of action based on their new monetary policy stance is not to do any kind of intervention and to try and control their inflation and their currency using interest rates like everybody else does. The problem I see with that is you're at 0 interest rate and everyone else is at 5. So you've got a hell of a lot of catching up to do. That's going to take a lot of time. And that's something you don't have when you're sitting up at this level. So today is critical in the fact that this is the all-time high for US dollar yen in recent years. And we are less than half an ADR away from it. So if you are in squeezes on this, I've scaled out of some of my yens, basically because I couldn't, I just don't want to hold them anymore. I have got more scale outs above this level as well. So I'm not going to hold this. If this breaks, I mean, this is a massive parabolic move. Look at this RSI. We haven't been up here. This is uncharted territory. If you put a line on the RSI up there on the 4-hour chart, yeah, you can see this is somewhere we've been twice. Yeah. Okay. Intervention. Yeah. Intervention. Both times there was an intervention. If I scroll into this, you'll see the intervention move. Yeah. This candle here is 575 pips. Yeah, on an ADR of 110. This candle here is 586 on an ADR. So these are 5 ADR moves in 4 hours. Yeah, these are interventions. This is what happens at this level. Yeah, we don't get to this level very often. And this is where we are again now, if you scroll out. Yeah, this level here, 150 is where we start getting scared. This is where it all goes wrong. This is where it did exactly the same last time. This is where we are now. So the difference between the situation now and then is that we've had our first interest rate hike in 8 years and there's been no mention of intervention. So today's the day, basically. We've got FOMC. So I think obviously it's a Bank of Japan holiday today as well. I think what the potential stance at the moment from the Bank of Japan and from the central government is we'll wait and see what happens in FOMC. If FOMC weakens the dollar, i.e. they decide that they are going to bring interest rates forward, the drop, or they've said they're going to confirm that June figure, we probably see the market maybe start to weaken on the US dollar and start to bring that move down. If it doesn't, we'll probably hear from Japan. But today, we are at that level. So, this is a critical point. It's one of the, I think somebody posted in the Discord channel this morning with that Braveheart hold. Yeah. If you can, and you're not in too much heat, I'd hold it. Because what's going to happen is if we do get up to this area, and again, this level on the RSI, that it's kind of like the line in the sand. Go back historically, in all time, not just recent time, all time, you will never, ever find the RSI get above that level, the relative strength between these two currencies being so weak, and it not coming down. Never happened. We never have never had a pandemic before, have we? Yeah, we did in 2020. So there's always unprecedented events that have never happened before. However, we can only look at history. History says you won't go above that level. So if anything, you want to be piling on the pressure and going, if I need to do aggressive drawdown control, today's the day. But you need to have a fallback there, because if it doesn't, you need to be out and take a loss. So it's a difficult situation, this yen at the minute. squeezing a lot harder than I anticipated, and the wrong move on a normal interest rate rise. So I mean by being kind of fundamentally confused at the moment, because this is not the norm at all. Interest rate rises historically through all time ever make a currency stronger, not weaker. Yeah, we're getting the opposite, but we've never. Japan is the only currency that doesn't use interest rates. So in my opinion, probably it's the market going, well, they don't use interest rates to control inflation, therefore it doesn't make any difference. Who knows? So I certainly don't, because I was expecting completely the opposite move on this, which I think a lot of people were. There's a lot of talk on lots of places at the moment, including major news channels, about what the hell's going on with the yen. And I think you'll find the Japanese government are as confused as everybody else. But they still have the opportunity to... Sorry, I just seen somebody smack the thumb in the chat. They've got the opportunity to press that button. And they do it completely out of the blue. Yeah, normally they tell us, they warn us, they say, stop it, stop it, stop it. But they don't say, we'll give you an hour. They just do it. Bang. So what you'll find is at some point, and this happened midstream last time, somebody said, hey, look at the yen. And it was there. I was like, there's the intervention move I've been talking about for the last 3 weeks. Yeah. So it will just happen. You won't have a chance to react. It will just happen. So the question is, have the Bank of Japan still got a stance of liquidating overseas assets to boost the yen, which is typically what an intervention move is? Yeah, they hold all of their currency overseas, which is why you have negative interest rates. There's no point in having yen in Japan because you're going to earn no money on it. You put it overseas in bonds, and mainly the US. They're the largest holder of US bonds. So they will just go, right, we're selling that lot. And it all comes into the yen, which is why you get that spike. So if that happens, you will have money flooding out of all currencies at the same time, because they'll be evacuating this. And typically what you will find is that will rally straight into the US dollar or the Swiss franc, typically the Swiss franc. So what you'll find is if that yen move does happen, the Swiss franc will power up massively and that will collapse, which is the other problem. The euro, the pound Swiss at the moment, rallying off this Swiss weakness. It is stalling out at the moment up at the highs. So, but again, this massively extended, massive squeeze against the Swiss franc. And we've got the Swiss franc interest rate changes happening on tomorrow morning, 8:30. So we'll be looking at that 11:45 tomorrow and see what they've done with that. If they drop that interest rate for any reason, and they have been known to do it without telling us, that Swiss franc is going to weaken. Everything's going to pile against the Swiss as well. So I'll be scaling out of all that Swiss franc. But nothing you can do about these at the moment. They're just two hideous squeezes. And before anybody says it, yes, it is always the yen and the Swiss franc. Always the squeeziest things on the planet are always the yen and the Swiss franc. Pains in the backside, both of them. There is an argument for dropping them, yeah. But there's also an argument for when you look at your P&L going, yeah, made a lot of money out of the yen last year. So one of those quandaries you have to do as a trader. Morning, Grateful Buster. So today is FOMC day. So typically on FOMC day, we've got Lagarde speaking at 8:45 as well, just be aware. So typically on FOMC day, which is this evening, we tend to get rotation because the market will want to sit there and not do anything. So unfortunately, if you're in drawdown like I am on some stuff, you need to sit through it because you've got to sit there and wait for the market to get this news. So two things are going to happen this evening. One, they're not going to change the interest rates. If they do, well, they won't, because they're just not going to do that. It's not the US way. They let us know exactly what they're doing because they are the world's leading currency. It's not in their interest to screw everybody around because then they won't be the leading currency. So that's not going to change. We're going to get the 5.5. What will be important is what is in this rate statement and what is in the FOMC press conference. So when the FOMC press conference comes out, this is where the press get an opportunity to poke Powell and say, right, what are you going to do? Are you sticking by the June? Is there a chance that we might slip again, et cetera, et cetera? This is where the market finds out really the hidden sort of little nuances and answers that give them a real indication of what's going to happen next. So what tends to happen is we get the FOMC fund rate, we get a bit of a whipsaw or a spike. The statement is released at the same time. The market takes a few minutes to digest the statement, and then you'll get a move which will tend to stall out. Or you'll get a whipsaw, which tends to just return to origin. Then 6:30, we get the press conference, and somewhere between 6:45 to 7 p.m., the market will have all the information it needs, and then it will start its move. That's when you tend to get the ADR hit and the continued movement, if there is a reason to do so. So the last few FOMCs that we've had have been very, very quiet in respect of movement after the press conference, because there hasn't been any reason to change. Because we know it's June, we're sticking with June. If he doesn't come out and say anything different, the stance is not any different, is it? We're sticking where we are. We're not going to move until roughly May. So although the market may start a move early, again, this at the moment, this is a situation no one's ever been in before, because we've never recovered from a pandemic through stock market crash into the highest interest rate climb we've ever had, into a freeze for as long as we've ever had, and about to start the biggest drop we've ever had. This is all new stuff. No one's ever been here before. So we don't know how the banks and institutions are going to react, what their positioning is, and exactly what they're going to do and when. So it's just a case of sitting there and waiting and digesting, really. However, obviously, the stance is going to be negative US at some point. So the question is when. So this is what's going to affect this US dollar yen this evening. So I suspect what we will probably do today is sit around up here somewhere for the next 3 or 4 candles, 4 hour, and wait for that FOMC. If it moves up, we need to watch the Bank of Japan. If it moves down, absolutely fine. No problem at all. So everything else that is stretched against the yen at the moment, obviously, if the US dollar yen starts to come down, confidence will return to the yen, and obviously the rest of them should drop as well. So it's just a waiting game, unfortunately, at the moment up here. But these, you can see by the RSIs, I've got the RSI dashboard up, which we'll look through in a sec. There's a lot of stuff really, really stretched at the moment. Big, strong moves. So parabolic for days on end, yeah, with no profit take whatsoever. Flags and parabolic. Double ADR days, yeah, where you get to these points where you're like the 80-20 levels on the 4-hour RSI. We don't get there that often. When we do get there, we come down fast usually. So, and it's normally a news event that causes it. So as you can see, Euro yen is starting to roll over this morning. CAD yen starting to roll over. Aussie yen starting to roll over. Some strength starting to come into this Swiss franc, but the yen, but the US dollar is pushing still. So they're buying into the FOMC statement at the moment, as you can see. But the yen is starting to roll. So we'll have to wait and see what happens with these. But your ADRs today, there's nothing extended on ADR. We've got our first weekly hits that we've had for a while now this week. And as you can see, it doesn't take a rocket scientist to work it out. They're all yen. Yeah. So the yen has hit its normal weekly range already, based on this 48-hour move that we've had against the yen off the back of the rates. So as you can see, the move is starting to retrace. So with these at the moment, you've got to kind of look at them as, depending on where you want to measure the move from. I mean, that is where the rate announcement was. So I'd kind of be looking for that type of move. You want to be watching if you want to get out of these yens for a nice shallow retracement down to 38, 50, or intervention. It doesn't matter. Yeah. Another thing, do not set your TPs on yens. If you're setting hard TPs in the market, as you can see, I haven't got any here. If you're setting hard TPs in the market, down here somewhere, miles away. Yeah. Because if that intervention move comes, and we still don't know if it's even a possibility now for the Bank of Japan, because they haven't mentioned it. But it is a holiday, so are they asleep? I don't know. If the intervention move comes, bear in mind you're going to be looking at somewhere in the region of 300 to 500 to 700 ADR, yeah? which is what we've had in the past. So that's 225 ADR. That's as far as we measure, because we very, very, very rarely, 2% of the time, ever go beyond that line in a day. Yeah, we're talking double, more than double that if an intervention move comes. So do not stick your TPs at 1 ADR on any yen shorts. If you're going to put hard TPs in, if that is. If an intervention move comes, benefit from it. Take the money. They're going to give it to you. Don't just get out because, oh, look at that big, quick 1 hour candle we've had to 175 ADR. That's just the first candle. It's going to be more of those. So, just play it sensible with this at the moment, because he's obviously got an opportunity for big moves. But this is the barometer. This is the one that the Japanese are worried about, because this is their main export partner for 90% of their business. And at the moment, it's not cost effective to do business with the US at this level. They just don't make any money. There's no point. So they need to do something about it. How now is the question mark. What's the mechanism? So, but as you can see, huge, huge moves. If you want exits on them and we get a flag, take them. Depending how big your balls are, whether they're made of steel or wool, you'll be holding. So we'll see. But that level is our kind of point of no return, as I said. Yeah, so this is where we put those intervention moves in. Yeah, so you can see them. They're very clear. Yeah, one candlestick. Normal candlestick size is something like that. Yeah. So those are the three major intervention moves that we had back in 2000 and when was it? 2022. Yeah. And then we had further big, strong moves, obviously. This is what happens. When there's an intervention, you get a month or so of sustained buying. Yeah, there's a reason not to do it anymore. So that is where we had the previous intervention moves, 2022. And then we returned to this point and we had two further intervention moves, which were smaller. They were only 300 ADRs. And then we had that threat. Okay, we'll do what you say, which is where the yen, they started to liquidate assets slowly and basically power the yen up. Then everybody had to flip the other way because otherwise they'd go underwater. So, this is critical point. But we'll see. We'll see what the Japanese do. So looking at the ADRs, there's nothing hit today. You are not going to get, well, you may get an ADR. If the US dollar continues to push, you may do. But it's very unlikely you're going to get any ADRs today because FOMC day is typically rotation. There's absolutely no reason for you to put lots of money into anything. Otherwise, if you're going to get the wrong side of it. If the FOMC statement comes out and says, actually, it's May, the US dollar is going to take off and you do not want to be executing orders, large orders ahead of that. You want to wait for that to execute the orders because you don't know whether you can make more money or get a better price based on what happens in FOMC. So the banks tend to sit on stuff, which is why you have rotational movement on these days. So that sort of thing, or that sort of thing is what you would expect to find for the next sort of 8, 10, 12 hours. Yeah. So that's 6 o'clock this evening. And 7 o'clock roughly is where you're going to get that move. Overnight, we've got GDP for the New Zealand dollar. Based on GDP figures we've had recently, very little movement off of them because we're not interested in that. It's all about the interest rates at the moment. So that's the yens and ADRs and what we're expecting today. From an RSI perspective, you can see everything is extended on these yens. So if we come out on the yens, so on the chart here, I've got the 75 and 80 levels, which are the nice big extensions. Yeah. And on the 4 hours. So if we come out to the 4 hour, let me just remove that 90 level. This 90 level, sorry, wrong one. Let me just find a spreadsheet a sec. So the 90-10 levels, yeah, just to show you what happens at these levels, yeah. So when I did all the back testing on the new EA, I was testing all the RSI levels, the typical RSI levels for the hourly and the 4-hourly time frame. These three here and these three here, yeah, those are the 90-10 levels on the 1 hour and the 4-hour charts on the 14, 21 and 28. Yeah, 14, 21, 28 RSI 90-10 extensions. So I wanted to test, obviously, the 80, the 60-40, 70-30, 80-20, 90-10 to give me roughly how many trades, what the drawdown figures were, what the profit was, just to give a good cross-section of information. Look how many trades. I've put zeros in these columns here just to remind me that there has never been a trade at those levels. Yeah, hasn't happened. This is on the pound US dollar, right? So a nice high liquid pair, big strong movements, get squeezed, etc., etc. So there was never a trade. It didn't take a trade because we never hit those levels. That is the 90 level there. That we've got on the chart, 89, but 90, yeah. And that is where we are at the moment on that US dollar yen look. It's just an it's a horrible word, isn't it? Unprecedented. You don't know what to do with it because you've never had it. But that is where we are. We're at that 90 level. So looking at the US dollar yen, all these yens, as you can see, we're extended and embedded at the 80 level. Now, the 80 level is the one where you get very little drawdown when we get there. Normally, on the testing that I've done, it's 2 to 3 trades if you take trades at the 80-20 level, but you're going to get a handful a year. Yeah, 40, 30, something like that. It just doesn't happen very often. But they are very, very, very high probability setups. So as you can see, we're there, bang, we're there. We're starting the move now, but we very rarely get there. There's one here behind my head you can't see, which is this move here. But as you can see on the chart, you might get 1 or 2 trades a month, maybe at those levels, yeah. And on the 4-hour RSI extensions, again, we're up at those levels again. I haven't got the 80 marked on this one. That's a good idea. Put them in a different color. So again, on the 4 hours, yeah, we've hit there once, twice, 3 times in the past. Drop. We had a second push and then a drop. 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 Yeah, we don't get here often. It's so rare to get here. And this is, you know, there's a massive argument. Yeah, that bit. But I mean, it pulled back, but you would have found it very difficult to get in on that massive catastrophic drop. But yeah, I mean, these are the trades there where there's the argument for just sit on your hands all month and just take one trade, but risk 5% on it. These are the ones, the 80-20s. Yeah. So what we've got at the moment is the RSI dashboard lit up with the 80-20s, which is just something we very rarely get, but it is all yen. So you shouldn't take all of these. If you take all of them, you're overexposing yourself. And right now, with what the situation is with the yen, we don't know whether there's an opportunity for intervention anymore with the Japanese. I think there probably is, because it's exactly this. They're not in any different situation, are they? I've used the analogy of your house before. My wages have come down so much and my costs have gone up so much with my mortgage, I no longer can afford my house. What do? You either move out your house or you do something about it. That's where the yen is at the moment. 150, we can't afford to trade with you anymore. Do you want to continue to trade with us? If so, drop it. If you don't drop it, we will drop you. That's the situation. They haven't got a choice. Go bankrupt or manipulate your currency. That's what it's always been with the yen. The question is, are they still in that situation? And I can't see any reason by moving your interest rates from negative 0.1 up. That hasn't changed, has it? Their economy is still in trouble. And they've now put their wages up by 5%, which is what the argument was and all the stagnation was all about. So now they know that they've got more costs coming, so they've got to do something about it. So I can't see that this can be sustained for any more than a couple of days, if that, before this all comes crashing down hard. So if you're going to pick one, which was just in Jimmy's question, he wants to pick two. Obviously, the US dollar yen, because that is the one that they will use as liquidation. So when you liquidate overseas assets, or when the Japanese liquidate overseas assets and put them into the Japanese yen, because their largest holding overseas is in the US dollar, that is the currency that tends to benefit the worst from it. Yeah. So they're removing all their US dollar and they're putting it into the yen. So the US dollar weakens as the yen increases, which means the US dollar yen is the fastest mover. That's the 500 to 700 ADR move. Second currency to choose, I would say you probably would want the CAD, because the CAD weakens off the back of the US dollar. And as the US dollar weakens, the CAD will weaken with it. So you'll get the second largest move off the CAD. So if we go back and look at the intervention moves on the CAD yen, where are we? Wrong button. The CAD yen intervention was 350. So 80, that's about 400% ADR, roughly. So 400 to 500 plus is what you would expect. The European currencies will obviously, it all happens at the same time. You know, nobody survives it. Yeah, when the Japanese are intervening, they're intervening. Yeah. 456 off of 142. That's 4 ADR. Yeah. Bang. Every currency is going to get hit. So it doesn't really matter which one you select, but you want to select the weakest currency against the strongest. So there's an argument today for picking the pound yen, because what's just happened to the pound? Our CPI figure has come out lower than expected, meaning what? We can drop interest rates faster, meaning what? The pound will devalue and weaken, meaning which one might move faster? Probably more the pound than the euro. There's no reason for the euro to weaken at the moment. They've said nothing about reducing interest rates until possibly July, but probably June with the US. So all of them basically are opportunities. Everything will move because it's the yen that's powering up. So every single yen pair will get hit at the same time. So, but we'll see. I wasn't expecting this move. So, you know, don't quote me on anything. I've got all the intervention moves right in the past, every single one of them. I was expecting this to drop on an interest rate change, but you know, market does weird things. So yeah, yen's obviously all massively extended on the 4 hour. The Swiss yen is sitting up at the 75. The Aussie is sitting up at the 75 on the 4 hour. So, you know, we're up at, and we're just about to trigger the 80 here. We're at 79.78 on the 4 hour on the Aussie. We're just at that level. Again, also coming up to resistance. This is where we sold from last time. We've got limit orders are going to trigger at these highs. Yeah, the market knows everything I'm showing you here. The market knows it all as well. Yeah, I'm not the only person watching these levels. The banks are watching these levels. The institutions are watching these levels. Everybody's keen to see what happens at these levels because they know what happens in the past. And that's all the banks. Don't forget, banks also have only got information from the past to go on as well. They have the ability to manipulate and move price, and they have the advantage of having trained analysts in economists in their organizations. But at the end of the day, it's a battle between two currencies, and one of them isn't going to let it go above that level, and it never has. So we'll wait and see what happens. But we are starting to move down now. So, you know, these are the opportunities you have to fill your boots when these moves actually kick in. So, but if it moves above that level, everybody's in the same boat. We haven't got a clue. So it could fly 300 ADR out the top, because as soon as people see that breakout, they might buy the crap out of it. We don't know. So be careful. Just don't go all in on it. Unless you want to. It's up to you. It's your money. But I'm not going to. So Aussie yen, massive extension. CAD yen, Swiss yen, Euro yen, pound yen, US yen, New Zealand dollar yen, not very strong. But everything else obviously really extended. The other extensions we've got are the Aussie dollar, New Zealand dollar. So that one's up at a very high level at the moment. We're embedded and extended on Aussie, New Zealand on the 4 hour. So big strong move squeezing on this one. Swiss yen we've already talked about. Euro, New Zealand. So again, big push there. The New Zealand dollar is getting hammered at the moment. It's just dropped off of the interest rate freeze. Again, from a fundamental perspective, the New Zealand dollar is sitting at 5.5 with the highest inflation out there. There is no way that they're going to increase that, but there's no way they're going to drop it with inflation up there. They can't. So why is the market selling the New Zealand off so hard? Reason. So again, a lot of moves going on at the moment, which just don't make a lot of sense. But then again, nothing makes a lot of sense in this market at the moment, does it? So pound New Zealand, again, all New Zealand based. So there's a good opportunity for mean reversions on the New Zealand pairs, looking for pushes back down. Massive extensions. Again, same thing as there and there. Just looking for the pullback. Doesn't mean it's coming down, just looking for the pullback for the next leg up, if they want a next leg up. Pound, not so much, because obviously we just had negative news on the pound. Don't forget tomorrow morning as well, we've got Australian news. We've got the unemployment rate for the Aussie. The Aussie moves the New Zealand dollar, and overnight we've got the New Zealand GDP. So there's two Australasian moves overnight. New Zealand US, again, New Zealand dollar, absolute getting creamed at the moment. So big, strong move down, more from there actually. So we're looking for that pullback to start. Yeah, so same as this. Looking for the pullback from there. Again, we haven't been down at these levels, these 20 levels. Yeah, we're back at support as well. So nice opportunity for a pushback out of that. I'm not looking for much of a move. You know, it's that's the average there. So ADR, I only need one ADR of movement. Always trying to get one ADR of movement. That's all it is. Just get an ADR hit and you're out. So that's extended. And the US dollar Swiss. Now, the Swiss franc, again, Swiss franc, we've got the news on Thursday. So again, Swiss franc, we are not expecting a drop. They haven't said anything about a drop, but they never say anything. So we're waiting to see what happens with the Swissy. We've got an awful lot of Swiss franc moving news on Thursday. So all the European news will move the Swiss franc. So we've got the PMIs for France and Germany coming out at the same time as the policy rate, or 15 minutes before and at the same time as the policy rate. Then we've got the SMB press conference. So all these euro moves will affect the Swiss franc. However, unlikely they will affect it until we get that rate announcement. So on the rate announcement, we're going to get the same thing. If they keep it the same, we'll get a whipsaw, or we'll get a move and then a freeze. And then the press conference will come out. Jordan will get poked to find out what your forward monetary policy stance is. And I think there's a good chance that they will come out and say, as inflation is so low, we will start to drop interest rates soon. Market will read into that next month. So the Swissy will probably drop. But may not say that. We'll have to wait and see what happens, obviously. So there's an opportunity for further weakness in the Swiss franc tomorrow. But don't forget, there's always two currencies involved. So, for example, the US dollar Swiss, if the US dollar weakens on FOMC and then the Swiss franc weakens tomorrow, we're not going anywhere. We're just going to put a V-shaped recovery in. If the Swiss franc powers up tomorrow after the US dollar has weakened, we'll be down here somewhere. Yeah. So as I said, this week is just chaos. There's news everywhere. All these moves and any squeezes that you're in at the moment can get undone literally in hours, just with one move. So all the Swiss franc pairs massively squeezed at the moment. Aussie Swiss actually not so much, but all the other Swissies have had a big strong push against them. Euro Swiss being one of the worst at the moment. That is starting to roll over nicely now this morning. Pound Swiss starting to roll over. US dollar Swiss is holding obviously because of the euro. the US dollar strength, and New Zealand Swiss coming down nicely. So lots of movement all over the gaff at the moment. We've got hourly RSI extensions as well on all of the yen pairs. Or we did. They won't be now because it's rolling over this morning. So all starting to roll over. But we've seen rollovers start before. Doesn't mean they're going to hold. So obviously today, it is a bank holiday in Japan today. This threw me yesterday because normally when you see this on Tuesday, you expect it to be a bank holiday on the Tuesday. But no, it's a bank holiday on the Wednesday. They decided to put it on the Tuesday, but it is actually today. So good one, Forex Factory. That's really clear. But I think what happens is obviously because this is after market, any news you get here like 9:45, this is kind of in tomorrow's market, really. I think that's basically what they meant. But really, it should have been in Wednesday, shouldn't it? So it's a bank holiday in Japan today. So obviously, not a lot of opportunity for manipulation and movement with them today. So we'll see what happens. But yeah, big day, big evening this evening, and obviously tomorrow. So today, I mean, we might get a move started on the yen. I mean, everything's overdue on the yen, obviously, but I'd be surprised if we saw much more than that sort of thing if we do get a move down and hold before FOMC, because the market's going to want to know what the dollar's doing before it does anything else. So how do the Swiss, which has been weakening in a squeeze since... Oh, now do the Swiss, yeah. Just downloaded the new EA. What time frames are you using for entry on RSI? I'm using 15 at the moment. 75.25, yeah. The testing that I've done on 5 and 15, there's not a lot in it. But on the 5-minute time frame, you get faster signals. So it's a little bit like using the market reversal alerts indicator in aggressive mode. You're going to get a lot more signals. So basically, I kind of have gone 15 because it means you're going to have a stronger move. So that candle there on the 5-minute chart, see the 9MA on the 5, you probably would have got a signal on that. On a 15, you wouldn't. Terminal there. So yeah, you need a bigger move, either a stagnation and drop or a big strong reversal candle, big bearish engulfing to trigger the entry, which is pretty much what you would get as a reversal alert on the 5-minute time frame. So I've just found the 15 to be slower signals. So US dollar yen, for example, yeah, you see the distance between these two entries is over an ADR. Yeah, so this is the new EA taking this. So that was the initial entry. That was the second entry because on the 15-minute time frame, once we got to where the next entry was, there wasn't a signal until here. And funnily enough, look, it's exactly the same spot as a reversal alert. Yeah, this is why I keep getting asked what's the difference between the position trader EA and the market reversal alerts EA. Position trader EA doesn't use market reversal alerts. The market reversal alerts EA, the whole purpose of it is it trades on market reversal alerts, market structure. That is the signal indicator. It's just one of a billion signal indicators. You can use anything to get into the market. The 15 9MA is quite similar. It means that price has stalled and dropped to enter a signal. What's a market reversal alert? Price stalling and dropping. It's a different structure, but you're going to get very similar entries. It's just so much simpler and so much faster because the amount of calculations and work that goes into creating this is a hell of a lot more. That's basically it. But you're going to get a very, very similar thing happening, basically. So I'm going to work on the close all button today, by the way, for those that are interested. And I'm going to possibly release an update today with the close all button and the ADR option to change it. So in regard to the Japanese intervention, I will set the TP for H1 hedge to 3 times ADR. Yeah. So yeah, I mean, if you're using any EA, so if you're using Market Reverse Alerts EA, or you're using Position Trader EA, or whatever you're using for automation to get you out of trades, if it uses a exit criteria of distance in ADR or percentage of account or money or anything, obviously you'll want to change that. If you want to go for the big move, don't forget, this is not necessarily going to be an intervention move. This was not an intervention move. Yeah. So if you look at this wasn't an intervention move. It was an intervention move. They intervened twice, and then they did a large liquidation, which kickstarted this move. So it was kind of an intervention that started the move. But if we get a normal market structure sell-off like this, that's going to do the same thing. If we get an intervention, you're going to find a 4-hour candle that closes here. Very different. One candle closing down here to a normal sell-off over a period of a few weeks. Yeah. So if we get that, it's up to you whether you want to try and ride it down and how far you ride it down. If you get an intervention, you're going to be out somewhere down here. So you don't want TP set up here. But if it's a normal move, you might want to get out up here because it might just be a pullback on a long. We don't know. Yeah. This is the thing. We've had a fundamental shift in the economic stance and monetary policy of the Japanese yen for the first time in a decade. We don't know what's going to happen with the yen now. It's new territory. We haven't been it. So economists can forecast and analyze as much as they like, but the market will make its mind up what it wants to do with the Japanese yen now, based on many factors. So the cards have changed, the situation's changed, which is why you need to adapt to market conditions as a trader. This is why all EAs fail at some point, because all EAs trade a strategy based on history. History's now different. Anything you've had built based on US dollar yen movement in the past, any market profiling, any modeling, is different now because the Japanese do not use the same model for their economy now as they did for the last 8 years. So things are different. What's going to happen to the yen now? Don't know. It might become something that starts to go into correlation with another currency. You might suddenly find every time X drops, yen drops. That didn't used to happen. Now it does because it's changed. So you've got to adapt to stuff. So this week, this next 48-hour period is going to be critical for telling us what are we doing with the yen now. Yeah, if they do not press the button and this thing is up there towards the end of this week, we know that something's different in Japan. Something's changed. Their monetary policy stance is not what it used to be. They are not. Either they can't or they do not want to intervene and drive their currency stronger when they want to. So all you can do is sit and wait. That's all we can do as traders, is watch. It will do what it does. Morning, Neo. What is one piece of advice you can a financial investor chew on? I don't know. It's a bit of an odd question, Sam. Don't know the answer to that one. Did I trade the pound news? No, I don't trade news. If you get signal on the 15 RSI, 15-minute RSI, but the 9 EMA cross doesn't happen for maybe an hour or two, would you still take the trade? I wouldn't, because I don't trade that. I don't trade 15-minute RSI. These changing market conditions is why it's good to use an evergreen indicator like RSI and ADR. ADR specifically, yeah, an RSI, but like I always say, with all indicators, it doesn't matter what the indicator is. There is always going to be a time where it does something that it's never done before. Yeah. So, you know, the 90-10 level there. Yeah. Just because we've never been above the 90 without a massive collapse or intervention move doesn't mean we can't. Yeah. So there's always going to be that point where you go, this has never happened before. Like I say, with the pandemic, we never had a pandemic before. We've never had banks selling and repackaging bad mortgages and passing them on to each other before to collapse the financial markets. You know, we've never had a war kicking off where we've suddenly now lost access to the world's largest supply of gold and oil. We have this last 5 years, that's happened. You know, there's so many things that can change and will change. The new thing with the Brazilian, Indian, Chinese financial situation where they want to become the dominant financial force on the planet. We've never had that before. That's coming. What's that going to do to everything? You know, everything's going to change. So the way that the RSI works is it measures the relative strength between two currencies. The relative strength or the relative power of currencies changes. So all this is doing is telling you what you can see on your chart. That's pushed up. I know, I can see with price action. But this, with any kind of system or strategy that uses any kind of automation or any kind of rule-based system, you have to have something that triggers a condition. There has to be a number that you select. That number hasn't got to be the same all the time. You can change it. So, you know, I used to use different RSI numbers and I switched RSI numbers because they were less effective because market volatility changed. So there's arguments for not using the RSI. And I've been thinking about this a lot since I've been developing this new position trader EA and testing all of this. You know, I know it doesn't matter which of these lines you choose. They all work sometimes, but they all fail sometimes. So you've got to have an indicator that is measuring something consistently in the same way for it to have any kind of possibility of forecasting future. These levels that we've only hit twice ever, we have hit them again in the past a couple of times, but I can't quite see, they're behind my head, but these are the 90 level RSIs. Yeah, there's only been 4, well, 3.5. That one I'm not debatable, but you know, 100% strike rate in the market pulling back. How far? That is the thing that is always the variable. We know that when we get to levels, the market goes into oscillation and it pulls back. They profit take the move because they have to. There's nobody left there that wants to sell, and they need to take the profit on the move they've just created the profit on. How much of it they take, that is always the unknown. So what we're doing as mean reversion traders is we are trying to guess or estimate how much profit they're going to take. And sometimes they turn into complete collapses. We'll be out here because we've got in and out, and it goes like that. You can't forecast this because everything's telling you should be going the other way, and you would get in there, you get out there, you get in there, you get out there, you get in there, you get out there, you get in there, you get out there. Yeah, this is what mean reversion is. We're just taking the profit with the banks. But you know, no indicator is infallible. Historically, you know, I can say you can go and check it yourself. Never failed. Does it mean my car's never broken down in 3 years? Brand new car, electric, 3 years, never broken down. I could get in it today and go, oh, it's not starting. Never failed before. Things fail. Things change. Yeah. So you've got to use, in any kind of strategy, you've got to have mechanical rules that give you conditions and give you signals. There's always got to be a condition, there's always got to be a signal, there's always got to be a stop out level, and there's always got to be an area you're going to take profit at, whether that be a fixed stop or whether it be scaling out with drawdown control. There's always got to be a mechanism to do things, but the mechanism changes and breaks at points. So we'll have to wait and see, won't we? But you can't look at this and go, I want to buy it. Too big. I was looking at some testing I was doing yesterday with levels. I was trying to find a good mechanism for measuring movement from highs and lows, because one of and this goes back to Steve Maurer. Anybody that's familiar with BTMM and Steve Maurer's work, he used to use a kind of like a 3-bar push type mechanism, if you like, which was if prices moved a certain measurement of its average daily ranges, you would typically look for a pullback. And I tested all this theory years and years ago. I even had a dashboard that measured 3 ADR movement from a recent low using the hourly charts, but it failed lots, but it also worked lots. So I was trying to find other mechanisms that would be comparable with RSI, but would measure the entire move. The problem with the RSI is if a move starts from here, it can get embedded, as we've seen. So if you were to measure the entire move, regardless of where it started on the RSI, you're going to have more chance of getting in on that leg. But it's trying to find the happy medium of how far it needs to have pushed in relation to ADR. So I was working on, I was looking at indicators basically that might be able to help with that, to put with the RSI as a confirmation, just to see if there is an edge to get in later, because a lot of people have mentioned to me in the past, which is true, when I'm in 2 or 3 trades, that's when you get in, because I'm usually in no more than 4 or 5 positions, trades in a position. So if you get in at 3, you're not going to be in more than a couple. You can do that yourself by just using the 80 or even the 85 RSI. You're not going to get there very often, but you're probably not going to take more than 1, maybe 2 trades before you're going to get out of a position. Yeah. The further it's extended, obviously, the more it's pushed, the less likely it is of going any further. So, but yeah, RSI this is why I use the RSI, because it is a very reliable indicator of relative strength. But most people's strategies do not work on relative strength. They work on indicators. I'm working on relative strength of bank movement, which is a totally different thing. And this is the best indicator I've found to measure that. So, but it also adapts, RSI adapts to market conditions. So if you've got low market conditions, the RSI will still give you a reading even when the conditions are low. If it moves a little bit, it will give you that reading. If it's very volatile, it takes a lot more for the RSI to get extended. So it's a dynamic indicator, the same as ADR, in the fact that it reacts to price volatility as well, which all the others like the CCI, the stochastics, the MACD, they don't react to volatility, which is why we use the RSI. So, but yeah. But yeah, so will be interesting to see what happens today. Can you just run the EA during working hours? Yep, if you want to. What happens though when a signal comes in, Wayne, when you're asleep? So if you want to use the EA just between set hours, you can set that. There's the auto trading times, and it will not take any new positions outside of those hours, and it will not take any additional trades outside those hours. It will not do drawdown control outside those hours. It will not do aggressive drawdown control outside those hours. It just won't work outside those hours. But if you set that to be 6 a.m. to 10 p.m., for example, and during the Asian session, the market pushed up hard on something you're trading and then came down hard, you wouldn't get into that trade. Don't forget, the Asian session is a session. Yeah, you want to be trading the yen, the Aussie, and the New Zealand dollar during the Asian session, because they don't move as much during European session. They move in the Asian session. So if you only want to trade European and US based pairs, yes, there's an argument for not trading before 6 o'clock in the morning. But test this, yeah? Stick it in the back tester, right? Do a test with, like, the reason I have this in here is to avoid the swap. That little period there where the brokers spread the crap out of you, gap up, gap down, muck about, get everybody's stops, and then return back to where they were. The idea behind that is, I'm not interested while you're doing your funny business, Mr. Broker, and stealing everybody's money. But if you want to use it just to focus on European markets, yeah, set it for 10 p.m. close, broker time, and somewhere 6 o'clock in the morning, because moves generally start somewhere between 7 and 8 in the morning. When we're waking up in the UK, the Frankfurt session is opening, banks are opening in the UK. But it's Germany that kicks off first. So there's an argument for using it that way. But test it like that, and then test it with your hours. Compare the results. You'll find that you'll get very different results on the Aussie pairs using European time frames, I would imagine. But no, not something I've tested, but you can test it. While attaching PEA, do we need to add RSI? Rahat, what's a PEA? I know what a P is. Yeah. While attaching a P, do we need to add the RSI moving average indicator as well to the chart? Do you mean EA? Do you want attaching the EA? That's what you mean, isn't it? No, the EA doesn't need any indicators. Just runs on its own. Don't need to touch it. It has moving averages built in. It has anything that your MetaTrader has built into it as standard. The POSIA, yeah, I know what you meant. Anything that your MetaTrader terminal has built in as standard, all the standard indicators, RSI, moving average, stochastic, all that lot, is all readable by any EA. Any custom indicators aren't. Yeah. You're on the M15 time frame, ADR and RSI, yeah. I'm down 6% because of yen movement. Yeah. Everybody is that's shorting this because it's squeezing. Nothing you can do about it. However, as I've just been saying for the last hour, today's the day. We should expect to see some movement on it. So we'll see. But whether we get it before FOMC, meh. What's the rationale behind selecting only non-correlated pairs to add to the watch list? So that you don't double up your exposure, basically. So if my watch list has everything in it, obviously, but if you wanted to reduce your exposure and ensure that you don't overexpose, you would pick pairs that are not correlated. So basically the main correlations that you'll find, and this is correlation changes as well, don't forget. So the problem with using correlation in trading to say, I'm only going to trade X pairs, is correlation changes. Yeah. So right now, you will find that there will be a high correlation between the CAD yen and the US dollar yen. Yeah. So if you look at the US dollar yen and then you switch over to the CAD yen, very similar. But look at the CAD yen movement today on the 5-minute time frame, and look at the CAD yen movement on the US dollar yen movement on the 5-minute time frame. US dollar yen up, CAD yen down. Why is that? Because the US dollar is pumping ahead of FOMC. The Canadian dollar isn't. Yeah. So that correlation will only last as long as the correlation is meant to be there. Good example, look, reversal alert happens there. 15-minute MA cross happened there. It's the same thing, guys. Very similar. The way that I teach exposure in the bootcamp is that you get into a trade based on your strategy. You get into another trade based on your strategy. If you've got two exposures on the same currency in the same direction, don't get into any more. You don't know which are going to correlate over the next month, week, whatever. There are pairs that always look very similar. So if you get into the Aussie dollar CAD and the New Zealand dollar CAD, they're very similar. It's probably not best to look on a 5-minute time frame, but you'll find very similar movement between these two. So if you were going to say, I don't want to overexpose myself, just trade the Aussie dollar pairs. Don't trade the New Zealand ones, because the Aussie and the New Zealand move together. Yeah, the Euro and the Swiss move together. Yeah, there's lots of stuff that moves together. So just don't double up on them. US dollar CAD, US dollar yen, CAD yen. Just trade one of them. Don't trade both, because if the yen pumps like a lunatic, CAD and US are going to move virtually the same. However, the Swiss yen will move differently, because if it's a safe haven run that causes that yen power, the Swiss will have the same power pushed into it, and the Swiss yen won't move. But at the end of the day, there is no way of, without looking at a currency correlation chart every day, there's no way of really saying how to manage it with using correlation. I don't use correlation at all. But I would always say, you'll hear me say it in here regularly. Aussie dollar, US dollar. Yeah. And New Zealand dollar, US dollar. Very, very, very similar. This one's, look at the price action here. I'm just going to draw it on. Yeah. New Zealand dollar, US dollar. And then look at the Aussie dollar, US dollar. Yeah. So you got the same sort of movement happening in a more contracted way. This movement is all the same. So Aussie dollar, US dollar, and New Zealand dollar, US dollar, virtually the same pair. The difference you'll find right now is the Aussie dollar, US dollar is doing that. The New Zealand dollar, US dollar is doing that. Why? Because we've had news on the New Zealand dollar. But that will undo itself, and it will return back to where the Aussie dollar is trading with the US dollar roughly at some point. But they've just out of correlation because of news right now, but that will return. So correlation obviously will change based on news. Yeah. It's a very, very hard thing to use, which is why I don't bother using it. Okay. Morning, Brian. Did you try to take only if you get an alert and get the second alert the next 3 days? There should be less trades, but the legs are more extended. No, never tried that. Time hasn't really got anything to do with anything, has it? Everything I do is based on movement, not time. If you took a first entry there long and you took a second entry there long, and instead of using the distance, you decided to wait 3 days, you still took the second entry long there. Doesn't make any difference, does it? Yeah, I was going to say, you're up early, Brian, aren't you? Isn't it the middle of the night? Can we add a feature to the EA to limit the pairs? Nope. You probably could, but it's too complicated for me to code. I can't be asked. There probably is a way to do it, but it's just trade. Yeah. Stop trying to play. I know why you want to do it, Rahat, because you can't be asked. Do the job you're doing, trading, right? People want to have everything automated. You have to do this job. If you had it so that it never got into 2 trades in the same direction, you would never look at a chart. The whole purpose is I want you looking at your P&Ls on a regular basis. I'm not automating everything, no. But you could probably find an EA to do that. You could build an EA to do that. Yeah, I've looked into ways of doing it, and there are ways to do it. Limit exposure automatically. But I want to have that ability to take any trade I want. Yeah. So the best thing to do is to watch your chart and go, holy crap, that's extended. I'm going to sell it. And do that. and then go, I'm short 3 times on the US. I'm not taking any more US trades. Yeah. Stop trying to automate absolutely everything. This is a tool that just literally does your job, as much of your job as you can for you. But about time we had some recent movement. Yeah. Not in the way that I wanted it to. Oh, that's the other thing. For those of you that weren't here yesterday, we looked at the 60 RSI, 60 ADR, 60 period ADR. I did a little bit more testing on it yesterday. Where did I store that? Oh, they're in here. Oh, no, they're in my other terminal. I can't find them. But I was testing the 60 period ADR yesterday because Mark said about it, changing the RSI, the ADR. So I did an analysis basically yesterday's good session yesterday. We looked into ADR in extreme detail, the differences between the different ADR readings between 5, 10, 15, and 20. We looked at 60 just out of the blue, which is a quarterly ADR reading. And it's incredibly flat in the fact that it gives a very slow change in reading. I did some testing with the EA yesterday using it. And the drawdown results are quite dramatically different. I've got to do some more testing across. I want to run a test today. This is my job today, as well as doing the other bits and pieces I was going to do on the EA. But is to run a test on every pair over 4 years using a 60 ADR, just to confirm whether or not it has a big impact on drawdown. It looks like it does. The testing that I've done initially shows that you'll be in your trades longer. So the average trade time is extended, but the drawdown, so far, I've only tested it on 3 pairs, but the drawdown is considerably less on all 3 of them. It might just be that I've luckily picked 3 pairs that happen to have lower drawdown, which is why I need to validate it by testing every pair. But if that is the case, there's an argument for switching over to a much higher time frame for ADR. And the difference is with the, and people have mentioned this to me in Telegram. I think somebody mentioned it the other day in Discord as well. With the ADR reading, with the market reversal alerts EA and the position trader EA and the ADR indicator, obviously they're calculated on a daily basis. So right now, the ADR is dramatically bigger on the US dollar yen than it was 2 days ago. So if you go back to this day here, that ADR reading will probably be something like 80. Now it's 120. Why? Because we've had a big day put in, and it skews those figures. When you look at a longer period, a much, much, much longer period, that number doesn't change an awful lot. The impact that this has on the EA specifically is distance between trades. So distance between trades we set at half an ADR or 0.75 ADR. Yeah. That number, that half an ADR, could be either, in this case now, 59 pips, or it could be 79 pips, or it could even be 39 pips, because that reading changes every day. So every day the EA is looking at it going, how far between my trades do I need to be? When I started the position 5 days ago, I should have been 39 pips apart. Now I should be 79 pips apart because volatility's increased. So there's an argument for that's a good idea. There's also an argument for let's use this number all the time, because this is the more smoothed average of daily range over the last quarter. Do we want to take this volatility over a short period of time into account or not? And this is something I've never tested. And it hadn't occurred to me until we suddenly did this the other day. So I'm going to run tests on this and see. And I think personally, this is why the drawdown is lower with a 60 ADR than a 10 ADR, because we are using, we are filtering out all of this high volatility short term, which means that we put our trades much further apart, meaning they're harder to get out of. Yeah. So if we're using a more average move, I think that's why the drawdown is reduced. And what we're also doing is sometimes we're getting into a trade and then we're using because ADR has been low, we're getting in quite close together. And then all of a sudden we're getting massive 2 ADR moves. And the next trade is taken somewhere up here because now the half an ADR is actually what used to be 1 ADR away. So we're getting very uneven entries, which isn't necessarily a bad thing because if the thing's going mental, you don't want to get in too close, do you? But equally, it makes it harder to get out. Your average might be 175 ADR instead of 1 ADR, which is easy to hit. That's hard to hit. So I'm thinking there might be an advantage to using that, but needs to be tested, needs to be verified. So it's an interesting experiment to try. US dollar yen pushing again. Look. Let's see if this is yen movement. This is a little bit of weakness coming into the yen short term. Very little. But obviously, US dollar rallying still hard. So lots of move on the US dollar again. Anyway, I will test that today. Just after 5 a.m., Brian. What are you doing up at 5 in the morning? About time we had some decent move yet. Looks like a massive drop coming in GJ. Daily. Massive drop coming in everything, basically. Testing a propulsion gap on... How can you test a propulsion gap on the daily chart when you're at all-time highs? There's no propulsion gap here on the pound yen. If you're looking at an old propulsion gap from nearly 10 years ago, forget it. They're out of that position. They're not in it anymore. We're out. Highs, all-time highs, everything. Yen. Yen made a bad decision. US dollar yen weekly range hit. I had the SIH WS30 at visual only yesterday and entered manually short. Do not close it now, and I'm in drawdown. Can you have a quick view at WS30? I don't know what you want me to say. You had a short. Yeah, well, I mean, if you got a short on, there's a good propulsion opportunity there. Pull back into propulsion. So we're pushing, we're at that level now. Nothing's going to move on this today until this evening. So this evening, this will either be up there or down there based on FOMC. It's just it's all about FOMC today. No idea where it's going. Can make individual custom EA only to limit positions for each pair you use with your EAs. Yeah, if you want to, do what you like, Rahat. You can get other. There's lots of EAs out there that will interact with other EAs. So all EAs work on a magic number system. Whether they use it actively or inactively, all EA trades have a magic number, right? So all of the position trader EAs, for example, all the position trader trades, for example, have a 999 magic number as default. You don't need to change that on any pair. It just uses 999. So if you had another EA that did a thing, whatever that thing may be, it might be it does drawdown control, it might be that it closes trades for you, it might be that it monitors exposure, it might be that it does anything. If you say, I want you to work on magic number 999, it will monitor every trade taken with 999 and it will do what you tell it to do. So you can have an EA built yourself to do anything and interact with any other EA that uses, and you just need an input in your EA to say what magic number do you want to manage, 999 in the case of position trader EA, if you don't change it, obviously, which is no reason why you need to. But yeah, you can do whatever you like if you wanted to have one that did that. Surely the times of volatility, you want a ADR that reflects it. a trade that takes days may take weeks or more. Yeah, possibly. I don't know. This is why I need to test it. The whole point of ADR is, for me, is to measure the average daily movement of an instrument, and also to calculate correctly the lot size to use on an instrument. So something that moves 150 pips in a day, you do not want to take the same lot size on it as something that moves 30 pips in a day. You want your lot size has got to be different. Your risk has to be based on the movement of the instrument. There's nothing that says you should be using the last 10 days worth of movement as opposed to the last 60 days worth of movement. It's still a measurement of the average daily range of the instrument. Instruments go through times of quiet and volatility, and that will happen multiple times a month. So when I did my initial testing with ADR, when I tested decades of ADR data 4 years ago, I looked at what was happening over a short period of time, because the whole point of it was, how much is this moving right now? So I thought, well, let's look at the last week, couple of weeks. Let's look at the last month. And that's as far as I went. Because you'd think if you're trading intraday or hourly charts, you would usually be in and out of a trade within a month. 90% of the 95% of the time, we don't hold for anywhere near a month, let alone longer. But you get the odd one where you're stuck in it, like the euro pound, stuck in it since January, because it's not doing anything. Yeah, it's stuck. It's completely stuck. Nothing. It's just not doing anything. Can't do anything with it. So the ADR figure right now is 28. If I use an ADR 60, it's 30. It's the same. 28, 30. That's the difference between the last 10 days worth of movement and the last quarter, 3 months worth of movement, is 2 pips. But what happened during the month is you had a push here, for example, over a period of 3 days of 725, 72. So that moved 2.5 ADR in 2 days. Now, the ADR reading here on that day would not have been 30. It would have been something like 45, 50, something like that, maybe. So if I'd have gone in short there, it would have said, use a second position somewhere up here. Whereas what happened is it's just 2 days worth of news movement, then it returned back to normal. So actually it would have been better to scale in there and get out that trade, because you're never going to get there, because it's just a news event that was a fluky spike. The 60 smooths this out. So and as you can see, the difference is 30 as opposed to 28. Now this is a ranging pair at the moment. So I need to this is why I want to test this over a 4-year period on all the pairs, because it does. I want to see range. I want to see squeeze. I want to see trend. I want to see normal market structure. I want to see what difference it makes regardless of market condition, because you don't want any indicator that you have to tweak. If you have to tweak your indicator, you're changing your conditions. If you're changing your conditions, your strategy is changing. If your strategy is changing, there's no consistency. If there's no consistency, you can't measure your results. You have no idea if you're working well or not. There's got to be consistency. So it's not something that you want to change, but I'm just interested in the difference between measuring short term. I've measured medium term. I've never measured long term. So I know the difference between that and that can be substantial. But the difference between that and that, the vast majority of if 80% of the time the difference between that and that is virtually the same, surely you're better using that, because it's going to give you a longer consistency. Don't know. But it's just testing. You know, this is what testing's for, is to try and give yourself the best possible opportunity or the best possible indicator. Nothing's ever going to work all the time, but it's just trying to reduce losses, reduce drawdown, or get into higher quality trades. You're just trying to make things as good as they can be, but you're never going to have the market doing what you want it to do all the time. It's just not going to happen. It can't. So we'll find out. I will find out anyway. But looks with the position EA, it doesn't have magic number for every pair. It has a magic number on 999. I'm not coding it. Yeah, I don't do bespoke coding. If you want something bespoke coded, go elsewhere. I don't code for people. I'm not a programmer. Yeah, my job is not programming. There are people out there that program. If you want to get something custom built, go and get it built. But there's no point in emailing me with your requirements. I ain't got time. Sorry. I'd love to, but I haven't got the time. And if you want my services, I'm $500 a day. I just made that up. I don't have my services, but if I did, that's what I would want to charge, because that's roughly what I earn a day trading. So that's what you'll have to pay me, because I'll have to take time out of trading, which I can't do. So therefore, I can't help you. I'm going around in circles. The answer is no. Where and how do I get the data for back tests? What for? Huh? In your terminal. So run a back test. I don't know what you mean. Run a back test. Your results will be in the results column. Know what you mean? I don't know what you mean, Max. There's your results. Not sure I understand your question. So you just export from there. Do you mean the are you specifically talking about the position trader EA and the export file? The export file will be in your, so when you do a back test tomorrow with the normal MT4 data. Oh, I use tick data. I use tick data suite for my back testing, because I can get data going back decades. Up to you. I would always recommend using tick data suite. It's a company called eareview.com. eareview.net. Yeah. Tick data suite. As it says there, the #1 resource for accurate back testing since 2009. Yeah. So they've been, basically they are a central repository for broker data, if you like. So brokers supply them with data. They built a piece of software that automatically integrates with your MT4 terminal. Yeah, and it's like, I can't remember what it costs. It costs 150 quid a year. Well, that's what I pay yearly, because I use it all the time. But if you want to just do a monthly one, and if you just want to do months worth of testing, yeah. So if you've got a new EA that you are looking to buy or build or whatever, and you just want to do some back testing for a couple of days or a week, just go and buy a month's worth and do your testing, and then get rid of it. But if you're like me and you test and build non-stop, you want it all the time. And the other beauty of this is there is a lot of inconsistency in broker data. So if you test on your broker, and then you test on Dukascopy data, and then you test on Darwinex data, and then you test on Alpari data, and you get the same result roughly with all of that, that gives you confidence that this is robust as hell, and it doesn't matter what broker on the planet you use, this is going to work. If you test on your broker, Dukascopy and Darwinex, and you get completely different results, one of them makes a massive fortune, one of them doesn't, and the other one blows the account, there's something wrong. So it's a really good way of ringing alarm bells. Most of the time, when that happens, it's because you're testing on either the 1 minute or the 5 minute time frame, and brokers will open the day and close the day at a different point. So, for example, on the DAX, on Robo Forex, the market opens 1 o'clock in the morning. On Darwinex, it opens at 1 o'clock in the morning. On Robo Forex, it opens at 7 o'clock in the morning. Yeah, there's 6 hours worth of data not there on one of those brokers. you're going to get a different result. You're going to get a different ADR reading. You're going to get a different moving average reading. You're going to get a different RSI reading. Every indicator on the planet is going to read a different number on those two brokers. If you test the hourly charts, you probably won't find there's any difference at all. Because hourly candlesticks, all that missing data is actually broker data, and you'll probably find that the first hourly candlestick doesn't have a lot of difference, but the 5-minute time frame will be radically different. So it allows you to do a lot of testing you can't do as standard with MT4, testing slippage, testing spread. All of this stuff can all be done. You can fine-tune the candlesticks so that they match your broker's candlesticks, because your broker may not supply data. Yeah, so there's always, if you're serious about it, you should always use tick data. For 150 quid a year, it's a no-brainer. Yeah, if you spend 3 months developing a system on a piece of crap data, garbage in, you're going to get garbage out. Always use the best quality equipment. It's the same as anything. If you're going to do this as a job, you want to use the right tools. That's the right tool, which is why I don't like MT5 backtester. I have no choice over data. You can do it, but you've got to spend hours titting about with all sorts of spreadsheets, imports, creating new symbols. Just open this up, install Tick Data Suite, and go, right, I'm going to open Tick Data Manager and download 20 years of data for the pound US dollar at tick level. And then I'm going to run a quick test visually, make sure that my candlesticks look the same as my broker's. Brilliant. Now I've got 20 years worth of what my broker would have supplied me if they supplied data. Job done. Press the button. So easy. But without it, you are going to get different results. If I turn this off, if I run 2 tests, I won't be able to run this test because I haven't got 4 years worth of data from my broker at the 15-minute time frame. But if you run a test with the last 2 months worth of data on a 5-minute chart from your broker, and then you use the Tick Data Suite, you'll see there's a slight difference in the results. Sometimes it's dramatic, sometimes it's not. But you've got to use the best available, really. But yeah, time horizon obviously is a main thing. If you want to test over a long period of time, whenever you do any back testing at the moment, I'm focusing my back testing in 2 segments. So this is probably not the best thing to. So obviously we had COVID in 2020. Which is, I think that's there, isn't it? No. Wherever COVID was. So basically my back testing at the moment is running from post-COVID to date and pre-COVID for about 4 or 5. So this is about 4 years, obviously about 4 or 5 years prior. But that period of COVID, I'm not testing over initially because it will blow pretty much anything, because it was a catastrophic event the market hadn't seen. What happened afterwards for months was a recovery that lasted a long time. You need to be testing that because you would have been trading that. But with COVID, most people were like, holy crap, they either got killed or they stopped trading until we knew what the hell was going on. So you've got to be able to adjust your testing. You've got to go with what it used to be in the real world before pandemic and what happened after pandemic, because the market is a totally different thing now to what it was pre-pandemic, because we started all the interest rate rise rallies and the stock market collapsed and everything changed, didn't it? So if you're going to robustness test your strategy, you need to make sure it's been working over the last 3 or 4 years. You also need to make sure it worked beforehand, because we don't know if we're going to go back to that previous condition we used to have. And if we are, you need to make sure you last it. So, it allows you to do all of that using tick data because you can get access to all of that information. If you just test something, people send me set files all the time for, it tends to mainly be for the opening range breakout EA and the stock index hedge EA. They send me these amazing profit curves and I look at And it's like, yeah, that looks great. What's the set file? Excellent. When did you test it over? The last 6 weeks. Come on. Yeah. It's just been lucky, isn't it, over the last 6 weeks? Now go and test it over the last 6 months. Didn't survive that, did it? Yeah. So you've got to be able to test over longer periods. And you also need an out of sample period where you've never tested it. So if you're going to use optimization, the optimization tool is great for finding good settings. But those settings, to be robust, you need to test it over a period of time where it's optimized, and then take that optimized setting and take it over a period of time that you didn't use for optimization to make sure that the data is fresh and never been manipulated by the optimization. And if it works there, you know you've got a robust strategy. But you need data. You've got to have a long period of data. Yeah. You have times where ADRs are low. You have times where ADRs are high. You have times where market is trending. You have times where it's ranging. You have times where there's black swan type events. You have to test your strategy over all of those areas to make sure it would survive them. And if you find that there is always a period where that strategy fails and it starts to make a loss, and if you analyze what was going on at that time, and it's always in a trending market, it doesn't work, you know you've found a mean reversion strategy. And if the market starts to trend, you turn the strategy off. However, by the time you've identified the market started to trend, you've made a loss. When you turn the strategy off because the market started to trend, if it goes into a range, you're not going to make any money, which is why backtesting with EAs is very difficult to do, because your determination of a range bound and a trending market is discretionary. Everybody will say this is trending at the moment. Yeah. And if you scroll out, other people will say it's in the big, is it a big range? If that's not, that's a really bad example. Euro pound. Yeah. Look at it there. It's massively range bound. Look at it there. It's still massively range bound. I can't find one, but you know what I mean. Yeah. If you show two people the same chart, one person might think it's trending, one person might think it's range bound. I can't find anything at the moment that actually it works on, but yeah, this is range bound. The CAD yen is range bound. At the moment, that's the lower the range. That's the higher the range. At the moment, we're just range bound, aren't we? Maybe. But anybody looking at that is like, holy crap, this thing's trending like crazy within a range. You know, it's all discretionary. So you have to test everything over multiple market conditions. ATR is a really good indicator to use. You will find on the ATR indicator, sometimes it's like this, sometimes it's like that. Yeah. If your strategy works in that condition and that condition, it doesn't matter whether the market is calm or volatile. Your strategy works. Great. Because the market spends most of its time either being calm or volatile, really range bound, really moving. Yeah. Like this. Right, that's what I've got for you today. I'm back tomorrow. I'm not around this evening. I'm going out, and it's FOMC. So 6 o'clock this evening. FOMC, Fed fund rate comes out. It's going to be 5.5. If it's anything other than that, I have no idea what will happen, but all hell will break loose, because they've said in no uncertain terms, it ain't changing until June. And if they decide suddenly to go, hey, it's March, it's just not going to happen. So, that's not changing. The FOMC statement highly likely probably won't say anything that we haven't heard before, because they keep saying the same thing. It's June. The press conference, however, we might get something dropped. So I would be watching the market from 6:45 to 7 o'clock, round about then or just after. And that's when you're probably going to find you get your movement. So thanks for subscribing, Yo Burrs. Welcome aboard. So yeah, so that's what I would look at for movement, not the news event itself, the press conference aftermath. That's when we're probably going to find the move starts. And that's when we will find out what the hell this yen's going to do. So we're on the way. We're nearly there. If it breaks that line, we're in uncharted territory. See what happens. Let's move out news events, changes in ADR. Could you use, for instance, a 22 EMA? Why on earth is 22 EMA? What relevance has that got? ADR's got nothing to do with moving average. Totally different thing. EMAs measure price. ADR measures range. I don't know. You could test it. Do some testing. Hopefully Santa Powell dropped some big bags today off to the gym. Yeah. Good luck, Brian. We'll see. Moving average of the ADR. Oh, I don't know. No idea. Right. I'll be back tomorrow, 11:45 tomorrow, because tomorrow is chaos. So just to quickly, before I go, I'm back on at 11:45 tomorrow because I couldn't pick a time to stream. So tomorrow is just complete and utter chaos. So I've decided to come on for the pound rate announcement. I'm not expecting it to change, but what I can do then is look at what the hell happened this morning with the SMB rate and the PMIs, and we can look and trade around these news events. So I'll be back on at 11:45 tomorrow. But the whole day, literally from 9:45 p.m. this evening when the GDP hits for New Zealand, we're going to unemployment for Aussie, PMIs for Europe, Swiss rate, German PMIs, press conference for the Swiss, pound PMIs, pound rate, US unemployment, US PMIs. Good luck. It's going to be chaos. So yeah, just adapt and survive. So good luck. I will be back tomorrow. Anything you need, let me know. I'll be in Telegram or Discord. And anything I see today, I will let you know. All right, so have a good day. Anything you need, let me know. Otherwise, I'll see you guys tomorrow.